Ladies and gentlemen, good day and welcome to the Banswara Syntex Limited Q3 and FY23 earnings conference call. This conference call may contain forward-looking statements about the company which are based on beliefs, opinions and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be no opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ravi Toshniwal, Managing Director from Banswara Syntex Limited. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and it's a very warm welcome to everyone on our Quarter 3, 9-month FY23 earnings conference call. I'm joined in this call by SGA, our Investor Relations Advisors, and our Finance Head, Ansh. I do hope everyone has had a chance to go through our updated investor presentation uploaded on the exchanges and our company website. So firstly, it gives me great pleasure and it is a real honor for me to share with you the Quarter 3 results of FY23, which have been quite exceptional and have been very satisfying. This quarter, our earnings were led majorly by the value-added sales that we had in fabrics and garments. The yarn demand was weak during this Quarter 3 due to prevailing market conditions. However, our diversified product mix allowed us to navigate smoothly through this challenge. We were further assisted by the fact that the coal prices reduced further, helping our margin improvement. For your information, about 60% of our turnover comes from fabric and garment and 40% from yarn. Our order book for Quarter 4 remains robust. Quarter 3 FY23 was tricky for our yarn business in terms of our production planning. The yarn demand being weak and our expectation of fiber prices dropping further caused us to take a very conscious and difficult decision to shut down some ring frames. This reduced our production by about 1,000 metric tons in the quarter. However, in retrospect, we do believe this was a good decision, as if we had produced unsold yarn, we would have had to make mark-to-market losses because of the reduction in the fiber prices. The company continued production of its fabrics in the robust market. It produced about 12.6% more fabrics as compared to the previous quarter. And in the garment business, the period of the last Quarter 3 was a period when there were a lot of holidays due to Diwali and other festivities and marriages, which resulted in a lot of labor absenteeism. And this caused our garment division to have a drop in production, which, although the demand was full and our order book was completely full, we could not achieve the turnover increase in our garment division, as there was a drop in our trouser capacity by 21% and a drop of 15% in our jacket capacity. So we achieved in our garment division a turnover of 88 crores in the quarter versus 104 crore in the last quarter. So as we see, there was, a lot of pent-up demand in the ongoing year, which appears now to have peaked by the end of Quarter 3 FY23. We do see that there are challenges ahead in terms of one, the earthquake that happened in Turkey, which will impact our yarn demand. The Turkey is a huge yarn market for us. However, we have still to see whether this will have maybe some unexpected demand for us in our fabric business and garment business. The slowdown fears globally need to be reviewed constantly, and we do see that the market is a little bit nervous. However, we look forward to our order book being okay for quarter four, and as far as quarter four is concerned, we do not see much concern. Coming to the financial performance on a standalone basis, our revenue for quarter three FY23 dropped 10% from 406.5 crores to 367.9 crores. However, despite this revenue drop of 10%, the EBITDA margins improved from 13.7% in quarter two to 15.7% in quarter three. And this is was quite encouraging for us. And we figure that the reasons for this are maybe due to the following reasons mainly. One, the average cost per meter for the realization we got on our major categories of fabric sold increased by about 4%, the price that we are getting from the customers. Number two, the reduction in the raw material cost happened with polyester reducing by 11%, recycled polyester by 6%, and viscose by 3%. And three, we had a reduction in our power and fuel costs. So the per ton coal consumption costs also reduced by 12%, which saved us about 4 crores. So on a year-to-year basis, in the 9 months, our margins improved from 10.8% in quarter 3 FY22 to 15.7% in quarter 3 FY23, which is a significant difference. As you can see, we are almost 5% better in our margin improvement as compared to last year. The profit after tax for quarter 3 FY23 stood at 29.4 crores versus 12.2 crores in quarter 3 FY22. However, it was less than our quarter 2 PAT. This, however, is because there was about a 6 crore tax benefit, a one-time tax benefit that we got in the last quarter due to shifting to the new tax regime. Now that we have moved to the new tax regime will apply across all subsequent quarters. So if we look at the fact that there was this benefit in the PAT in last quarter, we have actually achieved better EBITDA margins and better margins all around. On the sales front, the yarn and garment divisions witnessed a dip of 18% and 16%. The garment division would not ordinarily have dipped, but it was due to the production that we were not able to achieve that you had a dip in the garment division. And the fabric division showed a quarter-on-quarter uptick of 5%. Now, the muted division performance in our yarn division was due to the slowdown in the general market condition, whereas the garment division sales fell due to lower production during the quarter. The fabric division exceeded its sales due to a good order book and no constraints. The export sales in proportion to our total sales have increased by 1% in quarter 3. Garment and fabric exports have grown by 10% and 2% respectively. The quarter-on-quarter yarn exports have not grown and have actually decelerated by 30%, portraying the slowdown in the yarn business in exports. The domestic sales saw a dip of 11% in quarter 3. This was majorly due to lower volumes in yarn and fall also in the realizations of yarn. Now, if you look at our company, we have incurred a lower power cost of 45 crores at 11.9% of production value, vis-a-vis a 54.2 crores cost at 12.93% of production value in the previous quarter. So this is a good, healthy trend, and with coal continuing to remain stable and the freight prices going down from Indonesia, we see that there should be no reason for us to be concerned about the power cost increasing further. The moderation of 1% during the current quarter is due to the reduction in average coal consumption cost. So for quarter 3 FY23, the financial costs also have been in control, with only a marginal increase of 0.43% when compared to the previous quarter, and this too is due to the various yearly fees we pay, like renewal charges, stamp duties, lead bank fees, which we paid in this particular quarter to the bank and will not be paid in other quarters. So we think that overall the finance cost is also stable and continues in an environment where interest costs are rising to not increase. For the 9 months, FY23 production was significantly higher than the year of December 21, and compared to last year, if we look, we have seen that there is an increase in demand due to the post-lifting of COVID restrictions in the domestic markets, and as well as we had a low base effect as previous year production was anyway lower due to COVID restrictions. We increased the production lines in Daman for our jackets, trousers and waistcoats, one line each, and we built up efficiencies in the garment division through the training of our workforce, and the yarn production also increased by a margin of 5%. Our revenue grew by 37% from 833.8 crores in the last year's 9 months to now 1138.7 crores. So we are almost now at 1140 crores in turnover. The yarn division increased its sale by 7%, the fabric division increased its sales by 37%, and the garment division showed our highest increase of 52% when compared with the previous year. The year-on-year export sales have risen to 51%, whereas the domestic sales have increased by 27%. The major reasons behind the same, again, is the pent-up demand in FY23, which we now think is over, but we do think that the stable demand for good products will continue. The garment increase of 140% was on account of larger orders from international brands and is expected to continue. When we look at the domestic revenue, the yarn revenues were flat, whereas fabric and garment revenues increased by 55% and 93% respectively. On a 9-month basis, the company has been able to reduce employee expenses by 0.7%. This is partly due to the reduced production in the spinning to rupees 208.2 crores in the 9 months. No, this is something wrong here. The company has been able to reduce our employee expenses by 0.7% on account of internal efficiencies. And for the 9 months FY23, the power costs have decreased, as I said earlier, by 0.37%. And the EBITDA margin for 9 months FY23 increased by 78.4% from 87.6 crores to 156.3 crores. And margins improved from 10.5% to 13.7%. Now the PAT has also increased from 27.3 crores to, in the 9 months, 83.6 crores, and we are looking at heading towards maybe the first time ever in our company to achieve a PAT of 100 crores at the end of the financial year. So the company would like to highlight that it has dropped the plan to acquire a new D2C brand. Instead, it will build in a brand internally through its new subsidiary, Banswara Brands Private Limited. Thank you. And with this, I'll now open the floor for question and answers.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The The first question is on the line of Karan Gupta from Kavi Capital. Please go ahead.
Yeah, thank you for the opportunity as well as the detailed presentation. I have a few questions, so I'll just start with, if you could just share your CapEx plan going forward, as well as just discuss where the CapEx has gone into in FY22 as well as the first half of FY23.
Yeah. Okay. So thank you, Karan. We are looking at a CapEx plan going forward of spending maybe about 150 crores. And this 150 crores will be spent more or less 50 crores, 50 crores, 50 crores in the garment, spinning, and fabric division. So each one of them gets an allocation of around 50 crores.
Okay. And this is over what period? This is
over the next 2 years.
Okay. So in the garment division...
Yeah.
Go ahead.
Yeah, in the garment division, we invested in the current year 30 crores.
Right.
In the spinning, 10 crores. And in the fabric division, I think we invested another 15 crores. Yes.
Okay. So are these, most of these CapEx related to capacity augmentation, or are these maintenance CapEx, you're replacing existing machines, or if you could just kind of...
In the garments, it was mainly for capacity expansion, all our investment in garment. Whereas in spinning and in the fabric business, it is more related to modernization and improvement in quality and enhancement of new products.
Okay. So in the garment division, my understanding was like if you're converting textiles into, finished goods, a lot of it is manual labor that is involved, right? So is the CapEx for like sewing machines, etc., or are there any other big machines?
Yeah, there are washing machines, there are sewing machines, and our CapEx is also in building. But the reason that our CapEx is higher than other garment people is because our CapEx is in tailored clothing, mainly towards making suits, jackets, and dress pants, and not as much towards the casual part. And this requires some CapEx. And we have seen that the demand for our tailored clothing business has come back very strongly post-COVID. The tailored business is somewhere where we are finding that there has been a loss of capacity globally, which has not recovered. And this looks like a long-term thing where we can continue to build capacities as demand seems to be quite robust.
Okay. That's heartening to hear. So when you undertake a decision to, spend money on CapEx, like what are the underlying metrics that you track to see whether it makes sense from you for you from a financial perspective, not just growth? Like, do you target any return metrics, or is it more looking at what the industry demand is and where you think you can get some growth?
Well, the first thing we really actually look at is the market demand. And really speaking, in fact, we have CapExes available which are more flexible. And we do have the ability in our operations to do some job work outside and get, say, for example, weaving capacity available, or extra finishing capacity available for fabric outside, or buy more yarn from outside and increase our turnover. So, we have really looked at our business as three different businesses. We are in the business of selling yarn, we are in the business of selling fabric, and we are in the business of selling garments. And we see ourselves as three companies who are achieving objectives to improve profit in each of these divisions, and we have a divisional head for each of them. So as we look at investments, we look at a return based on the market demand in each, and our ability to leverage that demand through job work and outsourcing first. If we can do that, we would rather not put CapEx.
Right.
And if we cannot do that, and it is a specialized demand which requires us to invest in it, then we will do it.
Right.
But the constraint is eventually the market.
Right. Yeah, the reason I'm asking this is, your gross margins, your profitability margins, they all seem good over the past many years. It's just, given the large asset size, your returns on capital, they don't.
Which is why we are being very
appear.
conservative in our investments compared to most of our peer group.
Right.
We have in fact invested very little, and we continue to be quite conservative in making investments for capex.
Fair enough. Okay. I'll go back in queue. I have a few more questions, but I'll give others an opportunity to ask that as well.
Thank you.
Thank you. The next question is on the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you for the opportunity. Can you hear me?
Yeah, I can hear you, Tushar.
Yeah. So I wanted to know, this is the first time that I'm listening to the call and interacting with the company. So I wanted to know, outlook for next 3 to 5 years, especially in the context of your comment that, the pent-up demand is done with. So
yeah.
What kind of growth should one expect over a medium-term period?
So we are looking at the next, maybe say 2-3 years horizon. And in that we see that it is possible to independently build our businesses in maybe, 3 to 4 years. If you talk about, we are talking about having 1,000 crore yarn business, 1,000 crore fabric business, and 1,000 crore garment business. We think each one of these is scalable on its own. We have experiences which allow us to find the right market niches where this growth can be achieved, even though there are headwinds from the market. And where there are always spaces of certain areas where the demand continues to still be robust. And those are what we are looking for, and those are where we are targeting our growth.
Okay, so basically doubling in 3 to 4 years from roughly
correct.
1,500 crore run rate to 3,000.
Yeah, this year, if everything goes well, we should close to 1,500 crores. So, we are looking at about doubling in 3-4 years, yes.
And what are the margins in each of these businesses in terms of sustainable margins? Quarter to quarter there will be variations, but each of the businesses, what kind of margins should one look at?
So we are targeting internally that we should be getting margins of 10% cash profit, or about, let's say between 11% to 12% EBITDA in yarn, between 12 and 15% in fabric. And in the garment business, it's a little bit less, but eventually cash profit should be the same at about 10%. The EBITDA margin, because there's less debt in the garment business.
Okay, so but your margins this quarter were higher, so they are not sustainable then?
Well, marginally less, yes. We are thinking right now it has been a very good period. Particularly for yarn, it was a very good period so far. Now we are seeing that yarn has really gone down. But fortunately for us, since we are insulated and 60% of our turnover doesn't come from yarn, comes from fabric and garments, we are okay. And our overall margin, if you look at the peer group, is still better.
And how much is internal consumption from yarn to fabric and fabric to garment? Or do they operate independently? And
they are more or less operating independently in the sense they transfer the product at market price to the other division. And the other division is free to buy it from outside if they get it cheaper. Unless it is a specific product that they want and nobody else can make it, then they are charged a premium accordingly.
Okay. And what is the average realization in garment, since you are in suits and jackets and those kind of things? And who are the customers here?
So our major customers we have both in the domestic and export market, and the export has really started to grow very well. So in exports, we are dealing with customers like Mango in Europe. We have large customers like Kohl's in the USA, and we have Express now wanting to come with us in the US market. Whereas here in India, we have all of the top suit makers. So every brand that sells ready-to-wear suits in India is our customer. That's from Louis Philippe, Van Heusen, Marks and Spencer in India, the BlackBerry, all of them are customers for us.
My last question, if you can speak a little more on D2C.
Sir, may we request that you return to the question, please?
Yeah, sure.
Thank you.
I'll come back in the queue.
Okay, thanks, Tushar.
The next question is on the line of Nirbhay Mahawar from N Square Capital. Please go ahead.
Yeah, congratulations for good set of results, sir. Just
Thank you.
wanted to understand, sir, on the garment export side, we are competing with Bangladesh, Sri Lanka. So these countries are seeing a lot of power cost escalation and all. So do you see that has started working in our favor? That competing countries are getting less and less?
Well, I think that Sri Lanka has had its own challenges, geopolitically, whatever situation and unrest. So they've really not been doing as well as they should have been doing. And Bangladesh has been a serious competitor, yes, and continues to be cost-driven better than us because of their lower wages. However, the power component is not really a very big factor in the garment business. So I don't see that the power advantage is what we are going to get. What we are going to get in India is the advantage of having the entire supply chain, right from fabric, trims and garments available, and to be able to deliver faster. Mm-hmm. So we are really talking about leveraging the supply chain in India, and the buzz about India being positive will only make this a virtuous loop. So as more and more garment industry comes up, more and more ancillaries come up, the hub of garmenting in India is getting a buzz around it.
And sir, when we are talking about doubling each vertical's revenue, are we looking at export component to go significantly higher than domestic, or this is across?
So we've always been more or less 50-50 about export and domestic, and we continue to maintain that. We are not overexposing ourselves to either export or domestic, because sometimes one market does well, sometimes the other does well.
But
India, by and large, we expect to do better.
Okay. So we see opportunity of doubling our domestic revenue in each vertical also.
Absolutely. Domestic is in fact easier to achieve the growth at this point.
Thanks. All the best.
Thank you.
Thank you. The next question is on the line of Keshav from. The line for the current participant has dropped off. We'll move on to the next question. That is on the line of Hiral, an individual investor. Please go ahead.
Thank you for the opportunity and congratulations for the good set of numbers. I have two questions. How is the export market picking up? And are we expecting some orders from Uniqlo and PHV Group, which you were looking at in last quarter? So any development on that side?
You're talking about Uniqlo and which other customer?
PVH Group from the US.
Right.
Yeah.
Okay. So Hiral, the export market in general, at this point, when you look at US market and UK, they have all ordered more than they really needed when this whole peak was happening of the pent-up demand coming in. So what happened is that most of these Western markets, and in fact I would say globally most markets, over-ordered because supply chains were broken and there was a concern about getting goods in time, and they were experiencing sales which were happening nicely. Having done that, they all realized that the sales were not as big as what the expected demand was, so they all slowed down a bit and lifted a little late. And this is why there is some slowdown now which we are seeing. It is probably not due to the sentiment of inflation alone, but due to the fact that this has also been an over-order made in expectations, which is, a sort of knee-jerk reaction to not having any stocks and then suddenly seeing demand coming and then trying to build up inventory. So once this settles down, I think the market is there, and a long-term shift of the supply base towards India and towards products that they can find, customers can find, which replace China, this will continue to happen. And we have a strong belief that this is what will drive growth.
So just in a continuation of the same question, that what, as per your estimate, could be the over quantity they might be having, a 1 quarter or a 2 quarter or less?
No, less, definitely less.
Okay.
They would have ordered less than even 1 quarter. It's just like even if you have 2 or 3 months of inventory that piles up, 2 months is enough for you to slow down and put brakes, because they keep getting numbers from retail. Okay. And they are ordering with a lead time of 90 days, 120 days, sometimes 150 days. So right. They have to always predict the future.
Okay, got it. And on Uniqlo and PVH, please.
So on Uniqlo, we have not yet broken through with a big order. We've got some trials. It's a slow and very, very tedious process, but we are enjoying the opportunity to learn, and eventually we will break through, is what we believe. For PVH, we have already secured many orders, and we see a big uptick from PVH.
Super. Congratulations. Thank you.
Thank you.
Thank you. The next question is on the line of Keshav from Raksan Investors. Please go ahead.
Hi, sir. What kind of impact do we see in the current quarter due to the situation in Turkey?
Right. So we see definite drop in our yarn export sales, and we see that there will be now a learning period, because right now we are not really, other than just be compassionate and understand what's happening with our customers, we don't really know the ground reality as well as to when the factories will be able to restart, what will happen, etc. Right now we're just, checking on your loved ones are okay, are you guys okay, everyone's fine. But this is something which will take a little bit while to know. Once we are aware of what the situation is, this is another supply chain disruption, because Turkey is a major supplier in Europe. And this can throw up certain opportunities in the fabric and garment business, but definitely it will impact the yarn business for some time to come.
Sure, sir. And what was the Turkey contribution in Q3 or 9 months, if you could give a figure?
For yarn exports?
The overall, yes.
I don't know that number. I don't, because we were not doing anything else to Turkey other than yarn exports.
Okay, so in FY22 it was about 16%. So any figures similar to that? I mean, if you could give any idea at all.
Right now.
Okay, sure, no problem.
I can't comment on that.
No problem, sir.
And but the point for us is right now that given whatever the market situation is in yarn, it will remain challenging. The question for us is that since we are consuming about 1/3 of our yarn internally in our fabric business, we have only 2/3 to deal with. We haven't expanded capacities in yarn. We have only added certain investments which are allowing us to make more value-added yarns and yarns that would be substituting what were being imported. So I think we should still try and find a way to, with lower margins, still manage our yarn business and average out our EBITDA by the improvement we get in fabric and garment.
Understood. So secondly, if I look at the last 5 to 6 years, we've largely been flat in revenue terms, and the product mix also hasn't changed much. So when we speak of the next 3 to 4 in the China Plus One theme, which would help us double our revenues, are a few contracts already in place that we started seeding, which will help us take there?
So I think that, you can already see that the turnover this year will get to around 1,500 crores by the end of the year. And that is a significant improvement over last year in terms of the turnover. However, it doesn't really account for a huge increase because there's been inflation as well. And so we're not satisfied with it. We want the increase to now come out of real sales and not just out of inflation. And this is something where we have gone to many markets and many new customers, As you say, some seeding has happened in many different places. Hiral had asked about the PVH, for example, but we have also improved our business with Express and Mango, which has happened in the garment business. And there are new customers who are engaged with us. So contracts will keep happening, and contracts are, some things which are like 2 months, 3 months order book position. That order book position is all right for us right now. We are just experiencing maybe in May and June, there may be a slight slowdown in our garment part. But other than that, it looks all very good.
Right. Thank you, sir. That's all from me. Thank you.
Thank you. The next question is on the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you for the opportunity again. I wanted to know about your D2C plan, and would it compete with your customers?
Okay, so welcome back, Tushar. As far as our going direct to consumer is concerned, no, we don't think that the market is so small. We think the market is huge in terms of what is happening on the internet and what is happening on e-commerce. And we are building the brands with various niches, small brands, which will allow us to, basically create the value of a brand over the next 3, 4, 5 years. But it's not a short-term project. This is something where a small amount of money will continue to be invested into creating brand. And this brand will leverage after the 4 or 5 years that it really needs as a gestation to create some impact and get to a turnover of 100, 200 crores.
So what kind of apparels will you be doing in D2C?
We'll be doing jackets and pants and T-shirts, basically casual wear, kind of like, the image of our clothing will be very comfortable and very sort of like in trend and casual. So it's going to come out in a few months, and then we'll share the campaigns as they come out. But we've just created a whole different team for it. They've been working for the last 6 months. Meanwhile, we had been working with many brands all over, so we quite understand the space. And we do understand it's very crowded and it's very difficult to penetrate. So we are doing it in a very, with a sharp focus on certain differences that we can create.
And would this be offline or online? What would the focus be?
It would start online only.
Online.
It will not start with so much offline. Absolutely. For the first 1 or 2 years, it will be online only.
Okay. Thank you. Thank you very much.
You're welcome.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Hiral, an individual investor. Please go ahead.
Thank you for the opportunity again. I wanted to understand about our technical textile and specifically about Tesca JV. How is the business picking up there, and what potential growth we see there? With what kind of margin we are looking in that business?
Yeah, okay. Hi again, Hiral. So we set up with Tesca, our automotive joint venture partners, a division in Chennai. And this is doing extremely well because it's much closer to our main customer, Hyundai. And we have been increasing this business quite well. And it's actually doing quite robustly right now. And we expect to be, making money in this quite well. The turnover should be around about 70, 80 crores in this business. And it's growing pretty nicely once we have opened up the Chennai part.
Okay.
So I think it's a nice venture where we are able to support them with fabric that we make in Banswara, but the final lamination and all of the putting together and then delivering to the customer is done in Chennai.
Okay. So what could be the margin profile in that business approximately? And what could be the growth?
Right now, margins are low in that business. There's a lot of capacity which had come up and people are really struggling. But let's say 2-3% margins. We're not losing money in it.
Okay. Okay. But going forward, can we see the margin improvement and the turnover expansion, or how?
Turnover is expected to expand, and margins will improve. Of course, that is continues to be our efforts, which means a lot of reduction in, value loss and claims that we were giving due to lead times. All of those have to be improved, which is already happening with the new factory in Chennai.
Okay. Okay. Great. Thank you for that.
Thank you. The next question is from the line of Atul Rastogi, an individual investor. Please go ahead.
Yeah, good afternoon, sir, and thanks for taking my question. Just had one query on what is the current debt as of December 22?
Current debt?
Yes.
Okay. Right now, as on December end, it stands at around 382 crores.
Okay. So it's come down a little bit from September, if I understand.
Yes, it has come down.
And so, and how do you see it, given that you have aggressive capex plans, and if you grow, your working capital will also...
That aggressive, no. When you look at it, we'll be making 100 crore PAT, and we have 150 crore expansion planned.
Yeah. So, yeah, and there will be working capital requirement also as you grow.
Yes, exactly. But that's not a problem right now. The banks are more than happy to. Our debt equity ratio is very good. There's really no constraint right now financially. In fact, we are being conservative in our growth, is what most people tell us.
Okay. Thank you, sir.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Nirbhay Mahawar from N Square Capital. Please go ahead.
Yeah, just a follow-up, sir. This 382 crore is our gross debt number or net debt number?
This is gross.
Is gross. So what would be the net number?
Ansh, do you know the net number? 1 second, he's just looking it up. Yeah, it is 340.
340. So, sir, if we look at our if everything goes as per plan, our cash flow from operation will be significantly higher.
Sorry to interrupt, Mr. Mahawar. Sir, we are not able to hear you clearly.
Yeah. Can you hear me now?
Much better, sir. Thank you.
So, if we look at our cash flow from operation, is going to be significantly higher than our capex. So, what would be the plan for incremental cash flows? Are we planning to deleverage?
No, we will reduce some of our debt maybe, and we will also see what we can do in terms of reducing the amount of outside working capital we need.
Thank you.
Yeah.
Thank you. The next question is from the line of Harsh Doshi from Analyze India. Please go ahead.
Yeah, hi sir. Thanks for the opportunity.
Sorry to interrupt. Mr. Doshi, sir, your audio is not clear.
Yeah, now it is clear.
Sir, slightly.
Yeah, I wanted to know what is the capacity utilization in all the 3 divisions?
So capacity utilization, if in the last quarter you look at, in the yarn division, we deliberately shut capacity. So therefore the utilization dropped and it went down to about 85%. And in the fabric business, we ran it fully, but it at 82%. Because we didn't have enough orders, in fact. And in the garment business, because we mentioned to you as we did that there was a labor shortage and we couldn't get enough workforce, the utilization was only 76%.
Okay. And can you let me know the peak capacity that we can do in all the 3 divisions?
So like I'm saying, the capacities in the fabric business, we have a capacity of finishing which goes up to almost 4 million meters a month. Okay. But right now we are only finishing 2.5 million or 2 million meters sometimes. Again, this depends on the product mix, etc. So there's a lot of cushion there, we can always get some gray fabrics from outside. We have started doing piece dyeing of articles which were coming in from China, and now we are making them in India. And this has got a very good demand here in India, since people are really averse to importing from China as compared to what it was before. So we're seeing that this whole business of expanding only depends on demand. If the demand comes for our product, we can use our capacities to run more than 100% of what we have.
Understood.
Using job work outside. The challenge is only in the market. The challenge is not in production.
Okay, understood. Thanks a lot.
Yeah.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Keshav from Raksans Investors. Please go ahead.
Hi, sir. When we talk about doubling up in 3 to 4 years, is it on the FY22 base or where we'll be at the end of this year?
We're talking about that being on the basis of FY23.
Okay, 23. And so what is our maintenance capex as a percentage of gross block on the current fixed asset base?
I don't know.
Any sustainable figure?
That figure. Maintenance capex, meaning
yes.
This would also include modernization, etc.
Yeah, of course.
Yeah, I think that you would probably spend around 40-50 crores a year.
Okay. And to cater to a doubled business, would we see a commensurate increase in the gross block also, or not as much?
There will be some increase in the gross block for sure, but not that high. Maybe about 300 crores or so.
Okay. So, sir, I think even as of now, we have done a 10% kind of cash in previous years. So going forward, with improved working capital cycle and also lower, higher asset turnover, are we being conservative in the 10% cash figure?
Well, we think that 10% cash is definitely achievable. Depends on the market. And if the yarn and the situation globally becomes more pessimistic and people's demands really go down, then we have a challenge. So this is something which we, would rather have a figure where we think we can get it.
Right, understood, sir. Thank you. That's all from me.
Yeah.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Naresh Mayani from Analyze India. Please go ahead.
Hello, sir. I have a very simple question. Over the last 10 years, you've did a expansion and modernization of 574 crores between the last 10 years. What has been in the last 3 years?
Okay. In the last 3 years, the investment has been quite nominal. In fact, we would have probably spent maybe about 100 crores or something.
So roughly around 670 to 700 crores of say total expansion cost over the last 10 to 12 years.
Yeah, that's right.
So in terms of say peak capacity, in terms of say crores, given that assume that you get all the orders in at 100% capacity, what is the top line you can do?
So this is what we feel that without, like about 150 crore more capex that we've allocated over the next 2 years, with that capex, we should be able to get to a top line of close to 2,500 over 2, 3, 4 years.
All right. So basically another 150 crores takes you to a peak capacity of 2,500 crores. Thank you.
Mr. Mayani, are you done with your question?
Yeah, thanks a lot.
Thank you.
All right.
A reminder to the participants, anyone wishing to ask a question, may please press star and 1. As there are no further questions, I now hand the conference over to the management for the closing comments.
Well, thank you everyone for coming into our earnings call and for patiently listening to our commentary as well as all the questions that you have for us. We look forward to meet you again in the next quarter at the close of the year, and look forward to be on this journey towards making India stronger in the textile industry. Thank you very much, everyone.
Thank you. Ladies and gentlemen, on behalf of Banswara Syntex Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.